start to slowly kind of see what other offerings are out there. Get educated, ask questions. Don't be afraid to ask simple questions is what I tell individuals. The simple questions are sometimes the best ones if it helps you to learn. Keep pushing forward. Continuous improvement, man, and live my life for trying to get better 1% every day.
Hey everyone, welcome back to the Harder Working Money Podcast. We have a great guest today, a normal guy that started as a W-2, went into single family, and now is moving on into investing in multifamily and maybe self-storage and things like that. He's going to give his story and where he came from and where he's going. Welcome Melvin Landry to the show.
Hey man, welcome. Hey man, appreciate it. Happy to be here. Thanks for the opportunity.
Yeah, no problem. I just wanted to focus more on with you just the normal guy backstory to start with, and then go into some real estate versus stock market, and then just some basics type stuff. And then
we could talk about my journey started real estate 2005. It was a passive endeavor for me, even though I was accumulating properties. And it got to the point all of a sudden, man, 4 or 5 years in, I got 50 properties. Like, oh crap, this is a business. Never really put my foot on the accelerator. I was just kind of just like, I'm worried about corporate America. I'm worried about, my professor. I'm worried about my jobs. I'm not worried about real estate, but it brought a good amount of passive income. So this is while I was single. I meet Jackie. We get married. We've been married 10 years. Jackie has the vision to open a business. We're like, okay, let's do it, right? We're not able to open the business unless I kind of have that capital, right, from the business, from all these rental properties I've accumulated over the years.
So you guys still have W-2 jobs, though, too, right?
I do. She doesn't.
Yeah.
She's retired, so she's doing the back end. So, we do the business, right? And the business is a total flop. I told you that, right? In Dallas, lost $1 million, closed the store before COVID. Well, thank goodness I had those rental properties.
Let's go into it because the listeners don't know that story. So why don't you tell us, how you went from W-2
I can tell it.
You ventured into a startup business, all that stuff.
Ventured into a startup business. Wife was the face of it. I was kind of like the backer, kind of financially, and we made it happen. We opened up Triple Net Restaurant in a Class A development in Dallas, and it was a grind for 4 years, a slow grind. She worked 70 to 80 hours a week, never collected a paycheck. This is for 4 years. My mother-in-law started working in year 2, 20 to 30 hours a week. She's 74 now, never got a check. I started working in the business heavy year 3, year 4. 30 hours a week in between my other jobs. I got multiple jobs. Catering, doing weddings, calling on office buildings, and got it to a 6-figure endeavor, and we still couldn't pay ourselves. So it was a flawed model. We decided to close it.
And this was a franchise?
Franchise, yeah, franchise. Decided
What
to
kind
close
of franchise?
it. Can't say, sorry. In India, can't say.
What type of food? How about that?
Desserts, sweet desserts.
Desserts, got it. Okay, so sweet desserts,
Yep.
got it.
Yep, desserts, and we knew at the end of year 3, after looking at the balance sheets and things of that nature, it's like, it's not sustainable, man.
Okay, so you were working your W-2. You still had your single family sort of on the side, churning away. So what did you guys do when you pivoted? That business didn't work.
Yep, yeah, it comes with recourse, right? Everything comes with recourse. So we, the landlord wasn't happy. So we figured out a way to settle with legal fees. Had to slowly sell off some of the portfolio, right, to accumulate cash. Legal fees are ramping up pretty fast. So really, really fast, right? So you deal with the franchisors and their group and their representatives, and potential arbitration, and those things are not cheap. They're not cheap at all. So got to the point where it's almost sold half of the portfolio. Needed the cash, man, and the opportunity. The market was like blazing nice, right? 19, 20. It was COVID, but people were looking for deals, so we were able to move some property and able to amicably settle, get to a point where, as we can depart. We don't have to be friends, but we can depart and kind of keep it moving. That was a learning experience as an entrepreneur. First chance I had kind of to be a entrepreneurship owner from a restaurant standpoint outside of real estate, and didn't quite go so well. But it was a learning experience, and I'll say, like I tell other folks I'll speak to, thank God for real estate. If I didn't have it, possible chance we'd be bankrupt, and who knows, probably wouldn't be sitting here talking to you today. So, yeah.
Okay, so where do you go next after that?
After that, you're in COVID, right? You're trying to, at the time, COVID 2020, our son's 5, 6, right? Trying to, dealing with that in. So the first day of COVID, my wife goes back to work in corporate America. So trying to build things back. And mind you, we still have an SBA loan that we're paying for. And by the way, we didn't get finished paying for until 13 months ago. So you still owe on your obligation. And we're never one not to pay our obligation. So wife goes back to work, man. We're in COVID. I'm working, and we're trying to rebuild. Kind of slowly idle on the single family real estate front. But, just trying to maintain within the COVID world. And then, I saw a couple of marketing parameters for a webinar tying into, multifamily. And I was like, man, I know I've been successful in single family. I got an education, I got a mentor, I did very well, and kind of passively with my foot off the gas, I got up to 62 properties. I'm sure
That's
I
a
can do
lot.
well.
Like, that's a
Yeah,
lot.
yeah, but it's over 8 years. So
Still.
yeah, so I mean, I was just buying foreclosures, man, buying foreclosures. Education taught me to kind of get direct marketing in place. I would send letters. I got many jobs, but I'm a hard worker, man. So I try to get at least 10, 15 letters out a week. I'm signing them, and sellers are calling. I want to sell. I don't want this. I got behind on taxes. Can you take it over? So I had learned strategies how to kind of take over liens, get them tendered, get the property fixed up, get renters in it for cash flow, wholesale some, flip some. And it became very profitable, man. But it wasn't my main focus at the time, right? So, but
It's
I was
still
still
a
doing it.
job. Yeah, that's still
It's a job.
major job.
It's a job,
Yeah.
right? One of my many jobs, and I'm of a job mindset at the time. Yeah, man. So slowly doing some additional single family, but we're kind of scarred from the business ordeal, man. So saw the opportunity to participate in a webinar for multifamily. I'm like, let me just give it a whirl. What I got to lose? Decided to go back to Dallas because I was living in Dallas 6 years. We moved to Pittsburgh, kind of like start fresh, if you will, and we had a line on
Yeah.
that, and ended up going back to Dallas. I'm like, what the heck, going back here, man? Went to a rat race to retirement seminar. I'm like, whoa, this is some different stuff. I can scale how fast? I can get, I can save on taxes even more than what, as a business owner, right? You get some benefit of tax benefit. But I can do even more with bonus depreciation. I didn't know about that. I wasn't really that educated on tax law. Didn't even care as an average Joe. Didn't really care. I'm like, man, other people doing it, and I was like, wow. So I'm like, okay, this is something that I may want to consider. So I looked at the investment for mentoring. I'm just like, look, the same model that proved me before in single family should correlate and hold true in multifamily. So I didn't hesitate to invest the money in education. Didn't hesitate at all. It wasn't, oh, should I think about it? I'm just like, I called my wife. We got to do this. We got to do this. I mean, it worked in single family. It's going to work in multifamily. It's the mindset. She was like, okay. So we jumped in and did it, man. Started going through educational modules. Started meeting people. Started going to events. Started kind of changing the mindset slowly in terms of opening up your ecosystem to multifamily, scalability, things like that.
What was that mindset? Just the scalability side of it?
The scalability, man, it's just like, man, I can buy one building. I could buy a 60-unit building, could be in a better shape than managing tenants, toilets, and termites of single family. Right? I had built a power team that took 8 years. So I figure I can scale relatively quickly and kind of change the game. And that retirement parameter can actually be now a little quicker versus what my initial mindset was. Oh, man, I'll work till I'm 60 and I'll call it quits and live the rest of my life. I changed that mindset within the last 12 months. Be like, no, we're not doing that. We need to shut it down 3 to 4 years max, passively invest, get to know a bunch of people in this space, and keep pushing forward and not take our foot off the accelerator, but sprint down the track. So
let's talk about your single family just real quick. For some
Yeah.
people listening that, have no rentals, they just put money in the stock market. You hear 50 or 60 single family homes, and that sounds like a big chunk. Are you managing those? Did you hit a ceiling where it was becoming harder to get, beyond the financial side of it, but just managing 60 individual locations and renters and all the problems?
Yeah, as I gradually ramped up 20, 30 units, I was kind of doing it myself. I was the de facto property manager living in Nebraska at the time.
Wow.
Folks knew that, but I was getting out to Western PA at least once a quarter, sometimes twice when I had issues. And I had I had a system set up, man. And I had a Google Voice number, right? Folks don't text my real phone. They text me Google Voice. I'll know, okay. And I'm kind of handle. And I had core contractors who I had knew, like, and trust. Hey, man, I need you to go ahead and take care of this here. And they take care of it. Just send me the bill. And they were like on an open retainer, right?
Got
I
it.
had my grass cutting, HVAC. I had all my core guys. And they were just a Rolodex, right? Just kind of go through and they would handle stuff for me. And I was managing that for few years, 20, 30.
How
And then
about
when I got
How about
40 and 50, I had to get a management, man. It's just like,
Got it.
I
Okay, I was
can't.
gonna say just leasing 60 alone, a lease a week.
Yeah, well, I did affordable housing, which made it
Okay.
really, really easy, believe it or not. And I would get calls. I was like a mini leasing agent too. Hey, I heard you have rentals, and do you have anything coming up in this area? So I guess I was a de facto leasing agent too, until it was just like, this is too much. Because I had a 9 to 5. I was teaching a few classes, living, traveling, doing other stuff. So yeah, I got a property management, and it got to the point where it's took a lot off my plate. But they still text me, hey, I got this issue. Sometimes 12, 1 o'clock in the morning, because they knew I was the owner, right? So
Yeah.
you kind of direct them to this and this. So yeah,
So
man, it became a job.
now you're focused on multifamily, they don't text you. Even as
No,
the GP in charge, there's a whole
no,
layer between you and the
yeah,
renter.
I don't get any calls. Don't want any calls. I'm part of a team. We're managing the managers. It's going quite well. And I'm slowly kind of shifting multifamily self storage, single family kind of going down. So moving along and kind of retreating from the single family ordeal. It was a good run though. So I'll say that.
So how about real estate versus the stock market? Did you have money in the stock market? Have you always just done real estate?
I do have money in the stock market, and I have stock money in the stock market just for one reason. I got an 8-year-old. I'm teaching him, son, you should consider investing in stuff that you utilize. So my stock account is pretty depleted. I've actually pulled money out of my stock account to invest passively, but I do it simply for the fact for him to show him just the basics of investing. So he wants to be a commercial pilot, right? We have stock in Boeing, we have stock in Airbus, we have stock in United, we have stock in Southwest. Of course, as every kid, Brian, you have two. They love McDonald's, right? We have stock in McDonald's, we have stock in Costco, we have stock in Walmart, right? So teaching him to, as an investor, right, keep alternative assets number one, but you know what? You need to understand and know the premise of stocks as well. And he sees his account. I put a few $100s in there a week, and this is a mass. It's just like, you can see how compound wealth matters from that standpoint. So for the basics, I still do invest in stocks, but it's only for my son's benefit. Otherwise, I wouldn't even deal with it because you have no control. You don't have control.
Yeah,
I
it's
mean,
true. That's something that I sort of recently in the last few years. I was all stock,
yeah.
and you're following. Even if you're deep into it, which most people won't go deep into the earnings calls of a company and things like that. Even when I did that, and you hear these earnings calls, and everything looks like this stock should go up, and it goes down, and it's like
It goes
why?
down.
It's some massive fund is shorting it, and this is happening. It's like this is ridiculous, like yes, long term the trend does have a percentage, but you're just riding it. There's no, you
You're
basically
riding a
just need to ride.
wave, and you can fall off for no good reason. So yeah, that's not a good feeling, man. It took last year or two for me to kind of realize that. So it's just like, nah, I'll do it for the sake of showing my son how to invest a very minimal amount, keeping him educated, keeping him understanding, and that's to the extent of that.
Yeah.
So yeah,
Like I like alternate investments more now because I feel like I have more control. I have more control to pick it. I can meet the person that's running it or the
running
you
it.
know
Yep.
the small company. It's not as I mean, yes, there are market cycles and conditions that can affect it, but you know what they are. It's pretty obvious. It's not like someone comes in and buys up 50% of all the self-storage in an area in 1 year and then tanks something. I mean,
Yeah.
it's easy to see the trends basically, and some of these assets obviously are resistant. I would say not immune, but resistant to these
Resistant.
trends. So
That's the right
obviously you
word.
don't want to
Yep.
be in an
Yep.
office. You don't want to be in an office right now, but you could see that even before COVID. Some of the office stuff wasn't always doing great. So yeah, you had time to adjust, I guess you would say. COVID didn't just cause the office thing. I mean, retail was also hurting as well. Malls were dying. Like you could see the writing on the wall on a lot of these asset classes. So I just like the control side of it. I had a lot of money put in the stock market when I had some great years, and I couldn't sleep at night just knowing like who knows what the government's going to do, what's going to happen. And long term, I know you can leave it in, you'll pretty much be okay. But there's a lot of stats, especially if you start looking at inflation. And I mean, people in this country haven't really dealt with that. But where we are in the in the money cycle of the dollar, 9% inflation adjusted, I think it is for the stock market, is not going to get you into retirement if our money supply does what Ray Dalio, the largest hedge fund manager in the world, says it's going to do. Your 9% ain't going to let you retire. And the stock market is probably not going to do well if, at some point when that starts to unravel. It might not be in 2 or 3 years, but I'm 41. By the time I'm 65, it's going to happen. The dollar is going to have a major, major crisis. And I want to have my money and assets in things that people need. You need buildings, you need housing, you need apartments. Like that will ride through those things.
And we'll ride. But
Stocks and
projected to
companies, I
ride
don't
through the
know.
rate. Yeah.
Yeah.
But tell
Yeah.
tell them, Brian, get diversified. Okay. Tell them.
So that's Melvin's
I can
podcast, Get
preach it.
Diversified. Make sure you
Yeah.
guys check it out. Okay, I had to jump in here real quick. I hope you're loving this interview as much as I am. To get all our content and stay up to date, make sure you follow us on social media under Brian_O'Neill_investor on Facebook and Instagram. And also remember to follow this podcast if you're listening to an audio. And if you're on YouTube watching the video, make sure you subscribe to this channel. Okay, back to the interview. Okay,
Yeah.
so we talked about stock markets. You're a normal guy, you had 50 or 60, single family units.
Yep.
You're moving into apartments. How do you make money as a passive investor in apartments? Like, what is it? Because some people think it's like a REIT, which is sort of a market traded fund. It's not. You are a percentage owner in the actual LLC that owns a building.
That is correct.
How do they make money? Like, how does this work?
So basically, right, when you're evaluating opportunities, particularly for apartments, one of the things that me and my wife we're pretty keen on is in terms of understanding that IRR percentage, which is a big deal for us. Another one that we're really keen on is in terms of the bonus depreciation, right? How we can really help mitigate our tax bill, which is, for me, that's number one. Mitigating my tax bill. I mean, distributions comes, that's fine. I understand being in real estate, right, that everything's cyclical. Right, so chances of earning distributions from an apartment syndication, in many cases, it's 50-50. Everything's projected, right? And you need to kind of get educated in terms of what those projections are. But for me, being able to get bonus depreciation, minimize my tax liability is key. And also, you know what, the distributions from the cash flow, for me, that's a cherry on top. For other folks, it may be their prime reason for wanting to invest, but for me, it's getting the bonus depreciation and being able to garner cash flow is an added extra for me. That's what I look at. So, additionally, I look at other ways of how potentially I can invest. I got educated thanks to getting into a program in terms of leveraging your self-directed IRA. I've worked many jobs over the years, Brian, and you know what? I had 401k sitting out in the ecosystem doing nothing but collecting dust and losing a few pennies every year. Like, I didn't know you can do that. So quickly moved those to a custodian, self-directed IRA custodian, and started investing in deals that I thought were favorable. Again, minimize my tax liability, getting upside, right? And I had cash to deploy as well. So one of the things I tell individuals is, you know what, with cash, right, you can really take advantage of the bonus depreciation on a self-directed IRA. Make sure you check with your tax consultant because everyone's situation is different. But taking advantage of that upside is a risk that I'm willing to take.
And just for listeners that have never heard of a self-directed IRA, basically an old 401k if you quit the job, or if you have an IRA, which basically sits in a brokerage. I didn't even know these things existed, and I went looking for different things out there for managing my money before I handed it over to a financial advisor. There's a self-directed IRA, which is basically it's just an IRA, except you get to control what it goes into. So instead of it sitting at TD Ameritrade, and that IRA can only access the products that they'll let you access, which will be stocks, bonds, and some things like that. A self-directed sits at basically as a custodian, which is like a brokerage sort of, but a custodian, which allows you a broader range of products and things you can put that money into. Basically, it frees up, it takes the chains off an IRA and lets you put it into, you can put it in the gold if you want. You can put it into a business investment. You can put it into apartments or self-storage. It's just an IRA that isn't chained down by the restrictions that the big financial firms put on their IRAs, which makes them basically only investable into the products that they want to offer you. It's basically all it is. It's just an IRA that's broader for people that understand that. And you can roll things into a self-directed IRA from an existing IRA, old 401k. You basically can just move it. You can move part of your money if you want to. It basically just frees it
Yep.
up. So
Yep. And let's talk about, Brian, the elephant in the room. Okay. Your financial advisor, your financial planner, who may try to discourage you from putting your money in a self-directed IRA. Okay. By you moving your money, you're taking away from the admin fee. So, in my opinion, I tell individuals, and just like to be, clear cut. I mean, you know, they are incentivized for individuals to keep their money in their accounts, whereas they're telling them what to do. Get freedom, get diversified, right? Look for ways that you can control your own money, and I tell folks that, and some folks don't want to hear it, but it is what it is. These financial advisors, they're the elephants in the room that want you to keep your money with them so they can keep collecting their fees and they can limit the power you have to diversify. So that's the question. I tell everyone the question you should look in the mirror and ask yourself. So same here. Yeah,
I was at a party a few weeks ago and talking to a few people about that.
yeah.
And I tread lightly, obviously.
Could be
But my
touchy, right?
backstory it is I hired a financial advisor when I had a good chunk of money. I was like, I don't know what to do with this. I don't feel qualified to make these decisions. Like I had been trading the stock market and managing my money for
Oh, really? Wow.
15,
Okay.
15, 15 years. But then I sold some businesses and the numbers got a lot bigger. I'm like, man, like I put a lot of time into trying to research this stuff and I still can't figure out the stock market beyond just averages. Like I can just put it in S&P or put it in an ETF. But so it's like I need to go to professionals. Went to someone, and where am I going with this? So at this party, basically, I heard people recounting back to me what I was sold from the same investment advisor. Oh, well, if you die, this person, your wife can just go to this person. They know everything that's going on with your finances, and they have a plan that they're following, and they'll just take care of everything. And that gives me peace of mind. I was like, that's worth 1% of everything every year, just so they can make a phone call and you know where your stuff is. Like, get a red folder and put it in the file cabinet and keep it updated. It's the same thing. Like the math behind the 1%, and it's not 1% if you look at it, if you really dive in these documents, and it's hard. I did it and like trying to figure out what's the actual cost here. It's more than 1% typically.
Yeah.
Once all the trading fees and all these other little compliance
That you
fees
don't
and
even
things,
see,
you can't find them. You can't find them. They won't show up on a statement. They're just
and they won't tell you.
they get placed in the trade. So as they're trading, these little fees are coming off, and it's really hard to find them. The point is, my financial advisor, when I went through it all, was guaranteeing he was going to meet the market average of the S&P 500. It said
Okay.
right there that the graph showed expected performance and S&P 500 performance, and they're like 0.01% different. I'm like, so I'm being actively traded. So we're paying some party beyond his 1% to actively trade this account, and your plan is only to meet the S&P 500. Like, what's the point? And
What's
it's
the point?
diversified in like 135 stocks, which
What's
basically
the
is
point?
what's the point of that?
You,
Sorry.
you could probably do better yourself, and you could probably save yourself some fees if you really kind of got up to speed and got educated, right? So, I mean, that's what most people, right? As some people won't, right? There's always gonna be a small sample size of folks. You can't tell them no different. They will just keep going the status quo, keep giving their money away, right? But I mean, yeah, what's the point? From fountain
It does take
averages.
time, and you have to want to learn this. It's a skill you
True.
need to learn. You don't need to be an expert on, stock trading to do it yourself. You
Yeah.
can manage it yourself. If you just want to diversify it out into a few ETFs or a few funds, do it. That's all they're basically doing. Every once in a while, they'll do some tax harvesting, which loss harvesting, which basically just means they sell Chevron when it's down, they buy Exxon, and they get you the tax savings from it. That's something you can do. But
But it takes a niche, right? I mean, to
I think the biggest thing that I have an issue with financial advisors is that they say that they are a fiduciary, which means they have to be in your best interest, but it's only of the products that they offer. So mine in particular said that his brokerage or his the company he worked for, the large company that he was representative of, only allowed him to do 10% alternate investing. So if I want to do oil and gas or real estate, he was only allowed to do 10%, and that's actually why I left him, because I
not a
was
good
like,
look.
why the
You did right.
10%? Like, why? He's like, oh, it's to protect you. It's to protect you, and that's why the rule is there. And I'm like, no, it's because you're just getting a load, an initial fee off that investment. It's not a recurring fee, is why. And I found out that what that fee was when I did invest with them for a while, because I ended up the next year investing in myself. I called the fund. I was like, hey, I want to invest again. And I found the real cost, and it wasn't the number I paid. Anyways, the point is, even if you don't, take all your money out of the stock market and do it yourself, just realize that you probably should have at least a part of it on your own in a self-directed IRA or in a cash. You don't have to give it all to your financial advisor, and just realize
Just
that
get diversified. Get
just realize that,
diversified, folks.
yeah, their version of diversification isn't what's out in the market. And they even call like what we do alternate investing. It almost has like, it's like bad name, not alternate, like as if there's investing and then there's alternate options. Like, no, it's outside what the financial firms want to offer. And if you look at most wealthy people and almost all family offices, which you can probably speak to, they are investing heavily outside the stock market and
Stock
bonds into the
market.
things we're talking about. So
Oh
that
man,
should say something.
it's a whole eye-opening experience of the different type of things they're investing in: real estate, cannabis, medical. I mean, it's eye-opening
Venture
experience that
venture capital,
venture cap.
startups.
Yes,
Yeah.
yes, a little bit of everything, literally. So pretty cool.
So let's cover one more basic question that I actually haven't covered, and it's accredited versus sophisticated investors. I think some of my previous guests have mentioned this, but I actually haven't covered it yet. Can you just give a quick overview of what an accredited investor versus a sophisticated investor is, and how that may limit or open what investments they can do outside in, real estate and self-storage and these other assets?
In order to be an accredited investor, if you're single, you must make at least $200,000 a year annually for 2 consecutive years. If you're married, you and your spouse or significant other must make $300,000 annually consecutively for 2 years. Being accredited versus non-accredited really gives choice to the type of offerings you can participate in. So, for example, me and my wife, right? My wife has since retired, but I've worked many jobs, and we've met the threshold of being a couple making $300,000 a year consecutively for 2 years, and that allows us to participate in offerings, particularly 506c, which is specifically for accredited investors only. If you don't
Or
fall
$1 million
within that,
net worth as
or $1
well.
million in net worth. Yep, that can work as well, not including your primary home, right? So that's another parameter if you fall within that ordeal, right? And there's verification services that can allow you to cross-check to see do you fall within that primary ordeal. You can participate in the 506c offering. If you don't fall within that respective parameter, and you have some general knowledge, or even enhanced knowledge of real estate, and understand the risks of participating in an apartment opportunity deal slash syndication, you would fall in under the 506b parameter. So if you're single, you're under $200,000 a year for 2 consecutive years. Or if you and your wife or significant other, you're under that $300,000 a year parameter. Or if you're less than $1 million in overall net worth, you can participate in the 506b offering. So there's varying differences. It's critical to have what we call the acronym PFS, Personal Financial Statement. That is something everyone should have. Everyone should know and understand their financial position, and they should be updating it at least 30 to 60 days, kind of understanding your position and to kind of see how your finances looked, and to understand can you participate in these type of offerings. Hopefully, I articulated that with my professor hat on, even though I'm
Yeah.
bald.
Yeah. That was good. It was read almost straight from the SEC guidelines. Yeah,
Yeah.
exactly.
Oh.
So
Teaching come behind
sophisticated,
me. Yeah.
yeah. So
Yeah.
sophisticated investors basically aren't accredited yet. So there's certain funds out there and offerings they can participate in. Accredited investors basically are completely wide open, and the SEC basically at that point assumes that you can manage your money well enough. If you make a bad investment, you're not going to go under, and they kind of take the chains off you as an accredited investor and let you make the decisions to pick who you play with as broad as you want.
Yep. Know, like, and trust the persons you're talking to, you're dealing with. Get educated by all means. Look, every opportunity is not going to be a home run. I'm in 11 deals. I'm in a lot. Every deal is not a home run. So just be mindful of that. Get educated. Ask questions. Don't be afraid to ask simple questions, is what I tell individuals. The simple questions are sometimes the best ones if it helps you to learn. And I tell students that as well, even if I'm in a classroom setting. So, yeah,
If you don't know what you're investing in, don't invest in it. Basically, don't just take
100%.
the pretty picture and the good sales pitch. Don't do
Yeah.
it.
The
If
pitch,
you're
the
just
pitch
banking
decks are
on,
beautiful. Yeah.
yeah, it looks good. They said this percentage. Don't do it. Know the person or really know what you're investing in. At least one of those two. One of those
Yeah.
two.
And establish parameters, right? I mean, have a certain target, whereas, if it's under X from your target criteria point, don't do it. Keep it moving. That's what we've established in terms of our core criteria points. We know where we want to invest. We know what our particular target internal rate of return. Everything's continuous improvement, like the old supply chain adage, right? In terms of individuals you're dealing with, got to know them, got to like them, got to trust them, got to know when shit hits the fan, how is XYZ person going to react? In time of crisis, you got to know that your teammates are going to tread water at capacity or like you are and going to help tackle issues for the betterment of the team and for the betterment of your investors. Protecting your investors' money versus your own should be the first and foremost, the number one parameter in this area of business, if you will. So,
Yeah, definitely looking at the general partners and their ability to protect the initial investment, number one, of all the investors. And that has to do with their ability to commit time to the project or whatever venture you're going into, if it's multifamily, if it's self storage, whatever it is. Is this a side gig they're doing at night? Or is this, do they have people on the team that can fly down there and spend a week there if they have to? And then do they have cash, honestly? Not everyone on the team needs to, but need to have a few people that have a deep bank account if they need to go, or credit lines or something, that they're the first line of defense. I mean, ideally they should have the business and the investment set up with a lot of reserves. You want to look at that, but the next layer of reserves is the general partners. The last layer of reserves are the passive investors / capital calls, which isn't the end of the world. But if you get to that point, you better hope that the first two have been depleted first, basically. Yeah. So just get to know the people. Don't just click on an advertisement on Facebook that looks pretty and watch a webinar and have some sales guy call you. And watch out for that kind of stuff. Doesn't mean they're not good. There's 506c offerings all time out there. They're advertising, but try to get to know them. I mean, go to in-person events if they have one. If they have a podcast, watch them. You can learn about people if listen to 10 hours of podcasts of them speaking. You can understand. If you listen to 10 hours of whatever, Bill Gates speaking, you can learn more about him than if you watch them for 20 minutes during a keynote presentation. It's the same basic philosophy. Not everyone like you and me can go spend weekends with people that we're investing in, really get to know them, and see them at the dinner table and out camping or on the beach or in meetings. But what else? What's another takeaway we should, for the last one? If we have passive investors, is who I focus on. It's business owners that are probably in the stock market.
you know what? I would say get diversified, get educated, start to slowly kind of see what other offerings are out there. There is a better way in terms of investing, in terms of opportunities. If one wants to take a further step, seek out education programs, right? I mean, now, Brian, every day there's a webinar in the evening, Sunday to Saturday. If you want to participate and get educated on multifamily, alternate investing, there's a webinar you can plug in, and it's free, Sunday to
And,
Saturday.
and there's some good people that are doing some
There's some
webinars.
good
I mean,
people doing some
Neil
good
Bawa,
stuff.
I listen to him, and he's speaking to passive investors, but he's a great presenter. And obviously, he wants you to invest with him, but you
Absolutely,
don't
but
have
there,
to. You can still
you don't
take
have
his
to,
information. Yeah.
and help make self-educated decision. Changing habits and mindsets. That's kind of a 360 for me, man. I'm a runner, right? Brian, we were, we're runners, and man, when I'm out on the trails now, I'm all for listening to somebody's podcast on multifamily, Old Capital series. Love listening to that stuff when I'm jogging. Helps the flow, and you're getting education while you're trying to improve your health, right? So, without health, right, there's no wealth, right? When we're pretty much that's some core metrics that we try to live by. So just get educated. There's a lot of intel out there. Go to Facebook. It's like over 50 Facebook groups on real estate, multifamily. Join the groups, get to know people. I meet a lot of people who are looking to invest there. Really heavy hitters, first timers. So there's a lot of free stuff out there. If you're strapped to maybe say get into education program or stuff like that, there's ways to get around that. That's for sure.
Are you in anything besides multifamily? Are you looking at self storage or anything like that?
I am.
Just
We're
passive,
underwriting
even
self.
passively.
Yeah, we're looking to try to be actively on self storage. There's a lot of opportunity in our own backyard, so it's a little trying to underwrite it and go do face to face with folks to kind of folks can see I'm a real person, if you will. So I'm learning that everyone's blitzing out postcards and marketing materials. A lot of these guys, these mom and pop guys, they want to see you face to face. So that's kind of making a difference, and being flexible and mobile is key. It's good having a partner, right, who can kind of, if I need to get out to say Cincinnati or whatever to go visit with someone, we're in a position, or get on a flight to go somewhere, Texas, right? If there's some issues, we're able to do that. So we've kind of arranged a situation to allow for flexibility for us to help us to grow and really kind of keep our foot on the gas. Versus before, way back when, right? I took my foot off the gas and be like, oh, if it comes, it comes, and it wasn't front and center to me from a mindset standpoint. So that has changed.
That's funny you mentioned mom and pop self storage. I'm in Utah in this medium sized town, and there's several self storage places that have probably been there since the 60s. They're clearly mom and pop owned, like just the sign and everything, you can just tell. And I'm just like, man, how do you get a hold of that person and just see what their long-term game plan is? Because it's either an older couple or maybe it was handed down the family, and it's sitting there on the main street, just the land alone, that its value is. And it's it seems like a great opportunity if you can figure out how to crack that nut and actually get in front of the owner.
Yeah, potentially. I mean, if you're reaching out, man, obviously you can reach out and kind of get a script in place that you feel comfortable with. Reach out to them, and you never know. If you're close by, man, having that sit down, mate, potentially could give you the leg up, right? So because everyone's getting marketing material, right? I mean, even on my single family stuff, I get bombarded with just marketing material, right? In terms of postcards, and are you interested in selling, so on and so forth. So yeah, doing something a little bit different from a niche standpoint help changes the game and give you the leg up. I'm always thinking about that now in terms of how can I be a little different than the next person to help kind of land that opportunity. I'm always thinking about that. It's continuous improvement, man, to try to give myself a better shot than someone else. It's a competitive nature, competitive landscape, right? So, yeah.
Cool, man. How do people learn more about you? You have your podcast, you have Moreland Equity. Give us the rundown of how to follow Melvin and Jacqueline.
Sure. You can follow me and my wife, Jacqueline. We have our website, morelandequity.com. So that's MORLAND equity.com. If you go to YouTube, we have a podcast, Get Diversified. You type in Get Diversified podcast in the search. I shouldn't be that hard to miss. So me and my wife, we're on there together. We're on Apple Podcasts as well. We are frequent participants in many mastermind groups. Education is the great equalizer. As a professor myself, I'm always looking for ways to continue to kind of enhance my mindset, change my habits for perfection, and live my life for trying to get better 1% every day. That's what I live by, and it's going well, man. So real happy and excited to be in this new arena, growing by leaps and bounds. Has been fantastic, and knowledge is power, man. So getting as much as I can, plug in at least 3 to 5 days a week, Brian, on a webinar, podcast, listening, in the grand scheme of working, right, getting the little guy off to activities, and I got to be a husband and a dad too. So first and foremost, so yeah, good balance, but it's good, man.
Awesome. Well, thanks for coming on the podcast, and make sure to put all the info in the show notes.
Sounds good, man. Thanks very much for the opportunity. Appreciate it.